Hello, and welcome to G&S Capital's 2022 halftime presentation. I'm Justin Soucy, and today I'm joined by Lou Harris. We're recording this on July 1st. Just a quick note from the attorneys, past performance may not be indicative of future results, and also just a reminder to contact us directly if you have questions about how you're positioned in your particular portfolios.
So for today's presentation, we're going to kick it off with a review of domestic equities, and we'll tail that into a discussion around international markets, bringing that back home to some inflation commentary about what the Fed has been doing this year and what's been going on in the fixed income world as well. And we'll wrap the presentation with just a quick review of our portfolio positioning firm-wide. So to kick it off with domestic equities, I'll pass it back to Justin.
Thank you, Lou. Yeah, so starting with the valuations component, one way to look at whether a market is expensive or cheap is to look at the S&P 500's price-earnings ratio. What you can see on this chart here that goes back to 1965 is that we did enter this year in pretty overvalued territory. Now, again, that doesn't mean that everything in the market was overvalued. As an example, non-profitable tech companies were extremely overvalued, and if they were on this chart, they'd probably be somewhere up here. But you also had bargains in certain parts of the market, like energy. So the good news is with this correction, we've come down into a more normal range, and that should be starting to create some opportunity. And recession, we've probably heard a lot of this on the news lately, a lot about the timing. Are we in a recession? When is the recession going to start? We don't believe the timing is really that important, keeping in mind that the markets move, pretty quickly. A lot of times they're moving before a recession even starts, and they're recovering before a recession is even over. So the markets have already discounted quite a bit of the recession talk. Where we are today is right here, this dashed line. So this looks at market declines of 15% or more going back to 1950. What we can take away from this is that if we do get a recession, these red bars kind of show us that pain can be a little bit deeper than if we have sort of a 15% correction without a recession. So again, we think there probably is going to be a recession. It might be sooner rather than later, but this is showing us we have some pretty decent declines already baked in. And then lastly, are we in a bear market? Statistically, we are. Anytime a market falls 20%, then it's technically in a bear market. So we have checked that box this year. One thing to highlight, though, is that a lot of times we mentally think that these bear markets are going to last forever. They're going to last multiple years. History would show us here that that's not necessarily the case. The date in the middle column here is the date where the market reached a down 20% level, and then the decline ended on this end date that you see over here. So a key takeaway here is that usually within the same year that you hit 20% down, the market typically finds a bottom in that same year. And then 1 year later, 3 years later, 6 years later, you can see that the markets typically, recover rather quickly. So it doesn't have to be the exact same sort of outcome this time around, but these bear markets do typically last a lot shorter than we think. I'll pass it back to Lou to take a look at international markets.
Yeah, so international markets were just continuing to struggle, and sent into kind of a tailspin from this Russia-Ukraine war. That just has a big squeeze on the price of commodities, the price of oil, and really, when the war started, we saw the largest outflow ever from European equities. And so we're continuing to monitor that. Even if the situation does get resolved, there could be months and months of time after that for a lot of these supply chain issues to correct themselves. So overall, it's just been a struggle for international markets, and this has just been a catalyst for that downturn. Now, when we look at international markets compared to other asset classes, international equities are ranking number 4 out of 6. And so they're behind domestic equities here in the US, behind cash and commodities. And so often when we look at these asset classes, we like to see where does cash rank against that asset class. And right now, Cash is ranking higher than 80% of the international market, not leaving a lot of opportunity to invest. So we're continuing to watch it because when the U.S. goes through these rising rate environments, it can lead to a little bit of a shift in leadership to international markets, but it could take a lot just because the U.S. markets continue to be stronger than international, and we'll have to see how this plays out once inflation cools off. But we'd like to see international markets move up in the rankings before we really take a serious look at making more of an investment. So Goldman Sachs put this chart together. We're continuing just to look at a lot of developed and emerging markets for where is there going to be wealth creators and in what region. So about 2/3, if not more, will be from Europe, Asia Pacific, ex-Japan, and then of course North America. So there's the small slivers you can see of Africa and the Middle East, Japan, and Latin America. Goldman Sachs at least doesn't think that we're going to see a lot of new innovators and disruptors coming out of those countries, but based on what's going on in Europe and Asia Pacific, excluding Japan, there could be some opportunities in the future. So just continuing to monitor that as we go forward. So I'll let Justin go into fixed income and just what's been going on with inflation and the Fed, and go from there.
Yeah, as everybody knows, the Federal Reserve is raising interest rates to try to contract money supply, get inflation under control, sort of slow growth within the economy. So what we're looking at here is the fastest pace of interest rate increases since really 1994. So that was the last time that the Fed was really raising rates at this quick of a pace. Now, again, keep in mind that the Fed lays out a path of how many rate hikes that they anticipate doing, what percent of increase at each meeting. So that's baked into this number already and baked into this increase. This will adjust from here if the Fed sort of gets more aggressive or more conservative going forward. When we look at inflation, really that's the key point of why the Fed's raising rates, to try to slow down inflation. There was a lot of money printed, a lot of money supply added during COVID, and now we're trying to suck some of that out of the system. The biggest contributors, oil, having its largest year-to-date price gains since 1999 and 1974, and then shelter or housing. The mortgage payment on a median-priced home has doubled since 2015. So you can see those components over here and what makes up the year-over-year gain in inflation. Shelter being this light blue here at the bottom has added quite a bit to this number. And then oil, which was really deflationary during the COVID environment, you can now see is contributing a couple of percentage points to the inflation calculation. So, again, some of this starting to get better, but this is kind of how we've got to this larger inflation number.
Yeah, and so it's sort of the moment that we're all waiting for is when is inflation going to start to cool off. And so we've seen some pretty small signs of the Fed's interest rate hikes having an impact on inflation, but not really a significant enough move down to stop what they're doing. So they're going to need to see month over month continued decreases in inflation before they take off the reins of raising rates. And so we're anticipating inflation to cool off slowly throughout the rest of the year. And really, once we enter into late Q4 into 2023, we should see inflation really cool off, as the larger rate hikes now should have the impact then. And so with that, we also see a shift in leadership in different sectors. For example, when interest rates are cooling off, it tends to fare pretty well for equities and not so well for commodities. And in the past year or so, when inflation has been running so hot, that does fare well for commodities. So these are just normal shifts that happen in an inflationary environment as the Fed is raising rates. And that's why we're just continuing to hold a lot of more cash, more dry powder, waiting for the inflation numbers to come back in before we start to get that back into the market. So moving on to portfolio positioning and construction, I'll let Justin take it from here as far as what moves we've been making from the beginning of the year based on allocations towards equities, fixed income, and cash.
Thank you, Lou. Yeah, so this slide here shows really firm-wide assets. So again, just trying to give you a really big picture view of how we're allocated across the firm. Obviously, your allocation may differ from this, but came into the year with a little bit of cash, sort of a normal bond allocation. And then as we moved into the first quarter and we got to March, you can see pretty significant increases in money market and cash assets. Did not increase the bond positioning because rising rates has a negative effect on bonds. And then as we get to the end of this quarter and get halfway through the year, you can also see another slight increase in the money market holdings. But then we have increased the bond allocation. So again, we feel like rates got high enough to where we could earn better interest on the short-term cash. Certainly not trying to go out and pick a bunch of duration or longer maturity bonds. So again, just kind of shows more aggressive allocation as we finished last year with a little bit of cash with markets being overvalued, and then how this defensive positioning has kind of helped weather the storm so far in 2022.
Yeah, and so as far as weathering the storm, traditionally when we go into these types of rising rate environments, we want to have more of a tilt towards value company versus growth. So, we've talked a lot about this in previous meetings and in client meetings where we really have seen outperformance and growth for so long that now, I say now, even from 2020 until now, we've seen a really big valuation change in fund flows out of growth into value. So it's typically going to be more defensive. It's going to be able to weather this storm a little bit better. And really, the last time we saw year over year really good growth numbers in the value style is from the dot-com bubble into about 07, 08. And so we could be in for a multi-year run for value as we're kind of getting out of this multi-year bull market. And so along that note too, just keeping an eye on sectors where there's strength and sectors where there's weakness when we go in and out of inflationary environments. We're pretty heavy on defensive sectors right now, like utility and consumer staples and healthcare. So, a lot of those tend to be flights of safety for fund flows out of things that work well. Like the energy sector that's working well now, continues to work well, may not be so great when inflation cools off, and we'll continue to make those shifts. Just as far as the timing of this cyclical type of market, the market is always going to be a leading indicator, and the economy will follow suit. So just based on this chart, we are somewhere in this dotted line box or rectangle where we're in a bear market from a technical standpoint. We're starting to see, the economy go into early parts of a recession and tip over from the top. And so we do think there's continued downside from the economy, of course, but by the time the market may have recovered out of finding a bottom and working its way back up, the economy is going to follow suit behind that, going into potentially a full recession and then early recovery and full recovery. So just a normal type of cyclical environment.
Yeah, and then our positioning on the fixed income side, we are keeping pretty short term. You can see for bonds that are 2 years out, 3 years out, you're earning pretty similar yields to taking 30-year bond market risk. So why take the risk at 30 years? So we're going to hang out here on the shorter end for a while longer till it seems a little more clear that the Fed is done with their rising cycle. And if we look at positioning on the cash standpoint, this is a Bank of America Global Fund Manager survey of how much cash is being managed by professionals across the industry. You can see that cash levels are pretty elevated even back from May. These numbers are probably quite a bit higher at this point in time. So that continues to happen. Again, we put some of this cash to work in shorter term bonds just to earn some interest on it. And then some signals we'll be looking for is when the market stops going down on bad news, or we get pretty oversold, pretty washed out, some of the indicators start to turn, and maybe the Fed sort of softens its stance and inflation slows down a little bit. Those will all be indicators to us that it's time to put that cash to work and that the market has further upside.
All right. So last but not least, cryptocurrency and Bitcoin. As you may have well known and read, we're in the middle of another crypto winter, and so we're seeing a lot of these exchanges actually go out of business. They're shutting off withdrawals. Essentially, they've run out of cash, and so the cryptocurrency market went from about a $3 trillion valuation in November of last year to about a $1 trillion valuation in 8 months. And so we've seen a very, very big drawdown. There's a lot of turbulence going on in the crypto market because just as of a couple of years ago, there was only about 2,500 cryptocurrencies. Fast forward to today, there's about 19,000 different cryptocurrencies. So not only is the Fed raising rates to tamp inflation, they're also secretly trying to tamp down this crypto market, which has just gotten way too ahead of itself and needs to have this type of drawdown to get to normalize it essentially. So we still don't have any direct exposure to cryptocurrency right now. We never have, and so just continuing to monitor it as it goes through these growing pains in the technology front to become a sector where we feel safe enough to enter. But I think we could be months, if not probably years, before we take a look at really investing in the cryptocurrency asset class. So continuing on just to see how this goes throughout the rest of the year with the rate hikes and inflation coming down. We could see a lot of cryptocurrency fans not become fans the rest of the year. So just urge you to be cautious if you do invest in cryptocurrencies.
Yeah, it hasn't necessarily been the store of value like gold has been and things like that. But yeah, new technologies are very volatile, as a reminder.
Yeah, to say the least. Yep.
Yeah, so to finish this out here, just again wanted to thank you for joining us. We wanted to try to get a lot of information into sort of a short period of time. We know your time's valuable. If you have any questions, please reach out to us. We hope you enjoy the holiday weekend with your friends and family, and we're always here to help. And if there's any questions you have, again, phone numbers, emails, would love to hear from you. But have a great weekend, and we'll talk to you soon.
Thank you, everybody.